Hi, everyone. I'm Jeanette Mulvey, the editor-in-chief of Co. by the U.S. Chamber of Commerce. I'm excited to welcome you to today's Small Business Update. We'll be addressing the impact of two recent bank failures on small business. In today's update, we are here to provide you an accurate view of what is happening in the banking world, what this means to the economy in general, and what practical things you could be doing now as a small business owner during this time. This Small Business Update is one of many events brought to you by Co, the Chamber's platform for small businesses. And I want to extend a special thanks to our event sponsors, Dell, FedEx, Oracle NetSuite, and Iron Mountain, who continue to make these events possible. A reminder to the audience that I'll be taking your questions in the second half of this program, but you can start typing them now or anytime during my interviews into the box on the right-hand side of your screen. Now, I'd like to introduce my guests today. I have three chamber experts who are going to answer all of my questions and yours. I have Tom Quaadman, Executive Vice President for our Center for Capital Markets Competitiveness, Tom Sullivan, Vice President of Small Business Policy, and Curtis Dubay, Chief Economist at the U.S. Chamber of Commerce. I'm going to start with you, Tom. Welcome. How are you?
Good, Jeanette, and how are you? And thank you for all that you guys do at Co.
You're welcome. And I should have specified Tom Quaadman. So, Tom, I'm coming to you first so that you can just kind of break it down for me. What happened this week with the Silicon Valley Bank, and what exactly did the U.S. government to step in?
Sure. No, thank you for that, Jeanette. And let me just start here and let me just say a couple things right off the bat. First off, everybody should take a very deep breath. This is not 2008, right? So this is a very, very different situation. And it's very localized, and it's not a similar situation as to what we faced in 2008, or even frankly, what we did 3 years ago in March of 2020 when the economy started to shut down as a result of COVID. So let me just walk this through a little bit. And it's a little bit of a complicated situation, but let me just sort of work it through. So you have Silicon Valley Bank, is a bank that has been around since the mid-1980s. And what Silicon Valley Bank does or did is that it is the bank for tech companies, startups, life sciences companies, and very often, and venture capital, and the venture capital industry that supports those businesses. And very often, those businesses would use Silicon Valley Bank for their operational needs, for investing. And it is Silicon Valley Bank has really been an important part of that startup ecosystem. So what happened was in 2021, Silicon Valley Bank had a large run-up in deposits, which was not necessarily unusual in the banking system. What they then did was that they then purchased treasuries, which are a very safe asset. But what they did is they purchased long-term treasuries with a low interest rate, and they did not hedge their risk against any interest rate hikes. So what happened over the course of several months was that as the deposits started to be withdrawn from the bank, and part of the reason why you had this run up in deposits and then withdrawal was frankly because of some of the COVID cash that was sloshing around. Silicon Valley Bank had to actually start to sell those long-term treasuries, and because there had been this rise in interest rates, they had to sell those treasuries at a loss. Consequently, under accounting rules, they then had to book a loss on the sale of those treasuries. They then had to raise capital. So during a phone call that they had with their investors on Wednesday of March 8th, they said, okay, we had a $1.8 billion loss. We're trying to raise $2.5 billion in capital to raise that, to deal with that. And what happened on Thursday was that about $40 billion was withdrawn from the bank. So to some degree, we've actually seen the first social media run on a bank. On Friday morning, the FDIC stepped in and took control of the bank. What happened on Friday morning was that the FDIC said, okay, we're going to make sure that we're going to guarantee the insured deposits up to $250,000. But the unique situation with Silicon Valley Bank was 93% of their deposits were uninsured because their customers were businesses. They weren't necessarily financial consumers or individuals. And what they said with the uninsured deposits is, well, you may be able to get 50% of your money. Well, the problem that started, right, was that a lot of those business customers were looking at this week and saying, I have to make payroll, I have to pay off my invoices, I have to do a number of different things to keep the doors open. I may not be able to raise that cash. So on Saturday and Sunday, we recognized that issue as well. We were in contact with the White House. We were in contact with banking regulators, really to see if there were ways to either for Silicon Valley Bank to be acquired very quickly, and or that there be some form of a guarantee regarding deposits, so that businesses could understand that they could access their cash. And that's effectively what happened on Sunday, was that the Treasury Department, the Federal Reserve, the FDIC made an announcement where they were going to set up an emergency stabilization fund. They were going to open up the Federal Reserve windows to allow banks to access those to ensure that those monies could be paid. Additionally, other banks could access those facilities as well to ensure that they would not be buffeted by any bad outcomes. And that has actually helped with the Silicon Valley Bank to stabilize things for the most part. Now, what did happen in the middle of this week was that we saw that Credit Suisse in Switzerland came under a lot of stress. I would park that off to the side. That bank was in trouble for many years. In fact, the European banking system, they quite frankly have not cleaned up the mess from 2008. So I would actually put that off to the side. There have been some issues around Signature Bank and First Republic Bank as well. The FDIC, Federal Reserve, and actually what we've actually seen at First Republic that's been in the news as well, is that we've had a consortium of large banks have actually put money into First Republic Bank. The reason why Signature and First Republic Bank have come up is that they were close partners with Silicon Valley Bank. So our mission here was and continues to be to ensure that the business customers of those banks have access to their deposits so that they can pay those bills. What I would also say is that the actions taken by Treasury, the Federal Reserve, the FDIC, with Silicon Valley Bank, with Signature Bank, also with First Republic, actually creates an implicit guarantee for the banking system itself for right now. So what that means is, and you've seen this with Secretary Yellen's testimony yesterday before Senate Banking, is that the federal government is giving an implicit guarantee to those accounts, and that has been helpful with working through these problems over the past week. So it's something we're monitoring very closely. I know we can get into some of the other issues, but that sort of is a breakdown of what we've seen happen over the past several days.
Sure. Okay. So the phrase that's sticking in my mind, and probably the mind of the audience, is not 2008. So can you talk just a little bit about, is this a symptom of a bigger bank crisis among regional banks, and this is just the beginning, or do you, genuinely feel like these are isolated incidents?
So I would say this, right? And when you saw what happened with 2008, you saw a systemic problem. I mean, when we were here at the chamber in 2008, we were actually talking at certain points in October of 2008 that the banking system was just going to shut down globally, right? We're talking about 3 banks here that are part of a very unique ecosystem. So again, this is not 2008. And let's take a look for a second how the stock market's reacting this week, right? NASDAQ and the Standard & Poor's indexes are up this week. We're not seeing the stock market take deep plunges of 1,000 points or 2,000 points on any day this week. So the market itself is reacting in this way. What we are seeing, and what should not have been unexpected, and I know we'll talk about this a little bit more, we have an inflation problem. As a result of that inflation problem, the Federal Reserve has raised interest rates, right? So when you start to raise interest rates, you're also going to start to restrict credit. So there are ways that businesses can work through that. As I said, at Silicon Valley Bank, they made a mistake where they did not hedge their interest rate risk. And we'll have plenty of time to do the blame game and understand where mistakes were made. But for right now, what we're talking about are three banks within a very unique ecosystem. But we also have the federal government, and as are we are monitoring things very closely. But even with the rise in interest rates, we do think that there are things that businesses can do. But again, and I know Tom Sullivan will talk about that. But again, remember what I said. Not 2008. Take a deep breath. There's an implicit guarantee. And this was all done without any sort of bailout whatsoever. This was done within existing powers. So it's a much different situation than we were in 15 years ago and even where we were 3 years ago.
Great. Okay, I'm going to come back to you in a little bit, Tom. So Curtis, hi, you are the Chamber's chief economist. So this is your day to tell us what this means to the broader economy, and does it change the like Tom mentioned interest rate hikes. So do you think that changes the outlook for interest rate hikes going forward?
Yeah, thanks, Jeanette. So I'm picking up on Tom's theme of this is not 2008. There's another major difference. The problem originated back then because loans were not performing. That signaled problems in the real economy, and then it exposed weaknesses in the financial system, which just metastasized all around the globe. Loans are performing right now. What's going on is largely a mechanical banking issue, specifically at SVB, and then it's causing the financial world to look under everyone's hood to see if they're going to have similar problems. How that translates over to the real economy, though, is a very interesting question, because we do have inflation remaining at a very high level. So we got the most recent data earlier this week, and inflation on an annual basis is still 6%. It's coming down, but not nearly as fast as everyone had hoped. That is a problem. That the Fed is focused really strongly on that, and now they have this banking problem coming on top of it. If we had had this meeting last week, maybe this time last week, maybe a little earlier last Friday, we would have been talking about how there was growing pressure on the Fed to re-accelerate interest rate hikes. They had been raising interest rates since March of 2022 when they did it in a big way. This is part of the problem that has arisen because of the rapid, big interest rate hikes they implemented. They started at 75 basis points, which is 0.75%. They did that a couple times, and they went down to a half percentage point, 50 basis points, and they've come down now to 25 basis points. But there was, because of the high inflation rate and because of the super hot job market, which is usually where higher interest rates show up first, because that is not slowing the jobs market, because jobs are being created at a really high rate and wages are rising rapidly still. There was this growing pressure as a week ago for the Fed to re-accelerate its interest rate hikes. And with all that's happened since then, where I think we are now is that the Fed is likely to certainly not going to raise a half percentage point on Wednesday when it next meets. So we're not gonna see that. The question then becomes: do they continue raising rates, or do they just pause? What we call a hawkish pause, which is they would not raise rates next week, but they would talk about how they are going to start raising rates again once the banking issues are fully resolved. And I anticipate that, I think it's still pretty likely, it's probably a 50-50 chance either way, that they either have that hawkish pause or they go ahead with a 25 basis point increase, making the case that inflation remains much higher than they want. The Fed wants 2% inflation. We're at 6. We're still significantly higher than where they want to be. That they need to keep raising rates to get inflation down because inflation is such a scourge on the economy. What lends evidence to the guess that the Fed will continue to raise rates next week is that the European Central Bank met earlier this week and they raised rates. And this was after everything was revealed with SVB, Signature Bank, and while everything was going on with Credit Suisse. So that they're outside Swiss. The Swiss are outside the ECB, but obviously much more connected to the European banking system. The ECB went ahead and said, we're going to have our 50 basis point increase because inflation is such a problem here. Now, they're behind us. We started raising rates much sooner than they did. But I still think it's a signal that, because the central banks do talk and they do try to coordinate, that the Fed is still likely to continue raising rates even while we are going through this problem in the banking sector.
Okay. Thank you, Curtis. So Tom Quaadman, Curtis was just talking about interest rate hikes. And I guess the question I have that I think this audience wants to know is, with the interest rate hikes continuing and these banking issues, I think there's a lot of concern about that this could really squeeze credit availability for small businesses who rely on that for starting and growing their businesses. So can you talk about that a little bit?
Yeah, I mean, we have seen, right, that there's this, that there's, more of a restriction of credit, and that is actually a natural reaction to interest rate hikes. And, one other point, just to, sharpen the point a little bit about what Curtis said is, we also had inflation numbers this week that were still at 6%, so still higher than normal, and about 3 times where the Fed normally would like to see inflation. So there's still, we will see, with these higher interest rates, we are going to see more of a credit crunch. I know for many businesses, it's a little unusual, right? Because to some degree, we've had about 15 years of extremely low, or even at certain points, 0% interest. So it's trying to really adapt to a new world order that, quite frankly, that's really what the norm has been for most of our history. So it's really, and I know Tom Sullivan's going to take a little bit of a deeper dive into this, but there's some actions that small businesses can take. But I do want to just emphasize again, a lot of what the government did this weekend and what we were also advocating for was not only to ensure that there was stability within the banking system, but really more importantly, that the business customers continue to have access to their deposits, continue to have access to their banking services without a bailout. And that's something that was accomplished, and that's something that we're continuing to monitor extremely closely.
Great. Okay, thank you. So yes, Tom Sullivan, I'd like to come to you. Tom is the Vice President of Small Business Policy at the U.S. Chamber. And I think, Tom, I'd like to talk to you, really like dig in on what this means for small businesses. So what can small businesses do to get ahead of a credit crunch if that's coming? Oh, you're on mute, Tom. Can you believe it? After all that, you're on mute.
It only takes us 3 years to figure out how to turn off the mute button. So thank you, Jeanette. I'll start in answering your question with a little bit of a commercial. I mean, the small business digital platform that you run, Co, provides incredible content that small businesses can use to learn how to get through tough times. And so a lot of what we've already touched on today, how does small business weather through a credit crunch? How do they weather through higher interest rates? All of the answers to those questions are within the content from other small businesses that you provide through Co. So getting into a little bit more of the detail, I asked Natalie Caddis yesterday. Natalie is one of the small business owners who I get to work with on a regular basis. She runs our small business council. And I asked her, what's your advice for small businesses? And she said, first of all, what we learned in COVID, when small businesses like hers, she runs a manufacturing company in Salt Lake City, were desperate for PPP loans. They learned the value of having a relationship with their banker. And Natalie's comment to me just yesterday was, not only is this lesson valuable right now, but to dig into that value, dig into that relationship. She talked with me about how she relies on her banker for investment advice, not just, is my money safe, but what should I be doing with surplus cash? What types of restructuring should I be doing to make sure that I'm in fixed rate credit instead of variable rates, which are susceptible to rising interest rates? That type of conversation depends on the relationship you have with your banker. And Natalie just advised me to advise small business viewers today, really focus on that relationship.
Okay. Thank you, Tom. I'll be back to you in a second. Curtis, based on all of this, do you have an updated economic outlook? Does this change your opinion or perception on whether we are headed for a recession?
Yeah, good question, Jeanette. And yes and no. No, in that I've been saying for a long time that we are very likely to have a recession in 2023 because of high inflation and the higher interest rates the Fed is implementing to get inflation under control. That was likely to sap consumer strength, pull back on business investment, and lead us into a recession. What has been surprising, though, is how strong the economy has remained in the face of higher interest rates and inflation and all the other things that we're thrown at in the last year plus. We're in what I've been calling the waiting place. The waiting place is where we're all sitting around waiting for this recession to start, but the economy remained really strong. We were calling it secondhand pessimism for a while because businesses and consumers were telling surveyors that things were bad and they expected things to be bad in the future. But personally, consumers were continuing to spend, businesses were continuing to hire, raise wages, and invest in capital. So I think all those things still hold. We've been in that waiting place, though. You don't stay in the waiting place forever. It's called the waiting place for a reason. Something happens eventually. What I think is possible is that the spillover from the banking issue that we're experiencing now will finally get us out of the waiting place and bring us closer to a recession that was always likely to come. Again, if we talked about a week ago, we've been talking about how all those recession calls were probably pushed further back into late 2023. Now we're probably looking again back in the middle of 2023. What's important to point out, and this is what both Toms have been getting at, is the mechanism that will accelerate us into a recession or push us over to it and lead us to a slowdown is the lack of credit. What's going to happen is that the creation of credit is really going to slow down while we go through this painful process of everyone looking at all the different financial institutions and figuring out who's in a good position and who might not be. And what that means is that there'll be less credit out there. So if you have an available line of credit that you tap to fund operations, that might be curtailed. If you need to get a loan to buy an important new piece of equipment, it might be harder to find. It might be delayed longer than usual. And those things, the uncertainty that arises from that and the actual reduction in activity will likely push growth lower and could finally chip us into that long-awaited recession.
Okay. So Tom Sullivan, with the idea that there might be a little bit less access to credit, and as Curtis just said, a recession is a possibility. This takes us to sort of a broader topic, which is small business resilience in general. So can you just talk, you've been working with and talking to small businesses your entire career, and you do this every day. What kinds of things can small business owners do generally to just be more resilient in the face of all kinds of events that are out of their control?
Well, thank you, Jeanette. I do actually have the best job at the U.S. Chamber. I get to talk with small business owners every day. A couple of suggestions that, I've heard. So the first is, I think, it's important to understand that small business owners are not immune to recessions. They are not immune to recessions. They are immune to recessions. And recessions are not immune to recessions. So the first is, I think, it's important to understand that small business owners are not immune to recessions. They are immune to recessions. And recessions are not immune to recessions. So the first is, I think, it's important to understand that small business owners are not immune to recessions. They are immune to recessions. And recessions are not immune to recessions. what I was told by Stephanie Sims, who runs a company called Financeability. She advises startups mostly in the Phoenix area about managing cash flow. What she has advised is to have small businesses really focus on metrics. And she advises small businesses, look at your budget, look at your projections, and then compare that to actuals. And as times become tougher, that examination of those metrics becomes more intense. And out of that regular examination of those metrics come solutions to get past a credit crunch. She also advises to focus on the profitability of every product. When you're looking not just profitability overall, but specific to each product of a small business owner, you're much more likely to focus on those profitable activities and perhaps pivot away from the non-profitable activities. Last, but certainly not least, is the advice to try to shift your credit into fixed rates. Those businesses that are relying on variable rates like credit cards or variable rate mortgages are much more likely to find troublesome times in tight credit. And so work with your banker to try to look for opportunities for fixed rates in order to get through tough financial times.
Okay, thank you, Tom. We are going to now go to the audience Q&A. We have a lot of questions, and Tom Quaadman, I am going to come to you first. We didn't really touch on this. So this person says, should I be worried if I am banking with a regional bank, which so many small businesses are?
No, look, small banks are, regional banks are a very important financial lifeline for small businesses and middle market businesses. And we've worked very closely with our regional bank partners over the years to ensure that there are sufficient policies in place. What I would say is if we start to look at this, right, of Silicon Valley Bank, again, as I said, part of a very unique ecosystem when you start to talk about tech startups, start to talk about life sciences startups. And in fact, the reason why Silicon Valley Bank existed was that other banks did not necessarily want to be involved in this space. So what I would say is, again, as I said, there's an implicit guarantee right now within the banking system itself, which I think is very important. Number two, when you take a look at the fundamentals of our economy, as I said, the stock market has actually been relatively stable this week, right? So it's not the shocks to the system that we were seeing in 2008. So again, I think some of what Tom was just saying about how to make sure that your relationships with your bankers are good and that there are certain things to be taken care of there. Those are going to be very important. That being said, obviously we're keeping a very close eye on things, but as of right now, I think things are actually are in relatively good and strong shape for businesses as well as with their regional banks and other bankers as well.
Okay, thank you. Curtis, this person asks, do you think the federal government has taken the right steps so far?
I do. I think the Fed mostly has taken the right steps. And the lessons that are being applied right now were learned starting back in the Great Depression and up through the financial crisis in 2007 and 2009. We just happened to have had, as head of the Federal Reserve, Ben Bernanke at the time, who had made his name as a student of the history of the Great Depression and what the steps that were, the missteps that were made during that period. And he didn't necessarily have the tools. He knew what he wanted to do. They made the tools up ad hoc, but that it largely worked to stem the tide of the financial crisis 15 years ago. They have those tools now, and they implemented them quickly and effectively over the weekend. And now if there is a run on another bank, no matter the size, no matter what part of the financial industry that it occupies, it should have the means to get liquidity to head off the run before it becomes a major problem like SVP.
Tom Quaadman, it looked like you wanted to add something there.
Yeah, just 2 points. One is one thing we should all know, and it's not necessarily something that everybody pays attention to, banks go out of business fairly frequently. And it's very often it's some of the smaller banks, whatever, that, there'll be, several times a year, you'll see that a bank here and there goes out of business. And some of what you're seeing the FDIC doing, they do on a fairly regular basis. This is just on a bit of a bigger scale than that. But also take a look at the tools that the federal government has used. It's not the extraordinary measures that we saw 3 years ago or even 15 years ago. So this is something that's calibrated to deal with that issue. And one of the issues that was being addressed, and one of the concerns for why the administration acted in the way that it did over the weekend and over the past week, which we were also, that we were also communicating, it was really what the impacts were for the business customers of those banks to be able to make payroll and to make their payments and all. And that's some of why those activities were actually done, was really to address those issues.
I'm glad that you just said I think you said that banks go out of business. It's not like they never go out of business, and because I think there are issues that are being noticed and corrected all the time, and maybe we're just not noticing them. And that leads to this question that this person asked, which is, how does the government or regulators know that other banks are not in the same position? So I'm asking you that question. I assume they're probably looking at it all the time, but can you answer that?
So look, regulators are looking through everything right now, right, in terms of banks and where they are. And what we would actually say, if you take a look, I think when we come at it at the end of the day regarding Silicon Valley Bank and possibly even First Republic Bank, there was a lot of information that has been out there for months. So actually, JP Morgan Chase in November wrote an investment note where they actually raised the issue of the interest rate mismatch within Silicon Valley Bank, and they highlighted that. The question I think that will now start to come up is, why didn't the regulators take a look at that then, right? So there's a failure of supervision. What we've also seen with Silicon Valley Bank was a rapid rise in assets, and I think there are going to be questions of, did they have the appropriate risk management tools in place, and did the supervisors actually do what they needed to do to ensure that was in place too? So that's why I said we are working our way through the crisis right now. We will get to those issues with these specifics, but we are also seeing where regulators are looking at everything fairly closely as well right now. Also,
Great, thank you, Tom Sullivan. There's a question here about, you talked about resiliency before, and this person is, I think, looking for some more specific advice on that topic. Like, if there was one thing a small business owner could do to be more resilient. Do you have any thoughts about that?
Thank you, Jeanette. Yes, 2 words: cash reserves. And the reason I say that is that there is a little bit of a history lesson, and there's some positive news here. When we worked with our partners MetLife to produce the MetLife and U.S. Chamber of Commerce Small Business Index right before the pandemic, it showed that about a quarter of businesses have less than 1 month payroll on hand if something bad happened. And so then we get through the pandemic, and small business owners, faced with the type of crises that we all faced as Americans, they became more resilient. And now there's this feeling like, hey, if I can get through COVID, I can get through anything. And PNC just put out a report a couple of weeks ago that showed that the percentage of cash reserves by small businesses has actually gone up. And that's very, very good news. So we have learned some really tough lessons throughout the pandemic. It turns out that a lot of those lessons are becoming very valuable to get through the ripples that we're experiencing right now.
Tom Quaadman, I think we've addressed this, but not explicitly. So this person is explicitly asking, do you see the risk of a domino effect and more banks failing beyond the ones that already have?
Look, as of today, we're talking about three banks. It is not apparent that there are additional problems out there. Look, Warren Buffett has a line, right, where he said, when interest rates go up, right, it's sort of like the tide going out at the beach. And as he said, when the tide goes out on the beach, you see who's swimming naked, right? And to some degree, we've seen that here, right? But again, as I said, it's something we're watching very closely. This is something where when you take a look at the market's reaction, as I said, the NASDAQ is up this week. And even where you see the Dow Jones is down, it's only down a little bit. We're not seeing these wide swings. So again, this is not something where we are seeing systemic contagion risk. This is something that has been, we're talking about Silicon Valley Bank being an important part of that tech ecosystem. And it appears that it is cabined off within this small sector so we don't anticipate those problems as of yet. But again, as I said, we're monitoring it very closely.
Thank you. Curtis, I have a lot of different questions here, but I think they all sort of boil down to one, which is I asked Tom Sullivan about small business resiliency, but I'm seeing a lot of questions here that are just talking more about the overall resiliency of the economy. So can you just talk about that, the kinds of checks and balances that are in place to stabilize the economy overall?
Sure. Yeah, I think it's a really important question. So from a very high level, the U.S. economy is incredibly resilient. It is always the envy of the world when these shocks arise. Think about how it took a while, but we bounced back really strongly from the Great Recession that arose out of the financial crisis of 2007 and 2009. In many ways, other countries were still recovering from it when COVID broke out, and yet we had a booming economy. We had a pretty big shock from COVID. It was a pretty rough couple months, and then the economy rebounded incredibly fast and incredibly strongly, which was in part why we had such a big run-up of inflation. So from a very high level, the U.S. economy will rebound from this or will weather the storm really well. Maybe it will push us out of the waiting place into recession. Maybe it won't. So that remains a possibility. The U.S. economy is always very resilient. What is a little different this time around, when you're alluding to responses from policymakers, is they are limited in their ability to react to this one. So on the fiscal side, I don't think you're going to see a lot of checks going out again, and a lot of, other than automatic stabilizers, things that automatically kick in when the economy slows. I don't think you're going to be seeing a lot of fiscal support because we're in this position with high inflation, in large part because of huge fiscal spending during COVID. And so it wouldn't make sense to send checks out during a slowing economy that's caused by high inflation, which would then just cause inflation to be higher. So there's not going to be a whole lot of support on the fiscal side. On the monetary side, the Fed is going to have to continue to raise rates until inflation starts coming down more rapidly. I still think that it's going to take until the end of 2024 for inflation to come much closer to that 2% rate. So it could be a rough, bumpy few months until we get fully past this period. The good news is, and I've been saying this for a while in all the presentations I do, that 2023 was going to be rocky. 2024 will be better, but still not nearly as good as, say, 2022 was. It's going to take until 2025 until we're fully past the impact of inflation and higher interest rates, and we are on a much higher and a more upward sloping growth trajectory. So things will be a lot better then. And that's back to the resiliency. The underlying state of the U.S. economy is in really good shape because it was in good shape pre-pandemic. And using the analogy and the imagery that Tom talked about, the tide going out, when you have a tide going out, like it's gone out during COVID and it's going out now, usually you have lots of people swimming without swimming suits on, and you have cascades to the economy. We lived through that in 2007 and 2009. It was like always another domino falling. the worst part of everyone's week was Friday afternoon, waiting to get bad news to destroy your weekend, but more bad news for the economy. That has not happened. We haven't had those weaknesses exposed in certain sectors of the economy. So that's what leads me to that hope and that belief that once we get through this rough patch, things look really good.
Great. Thank you. Tom Sullivan, I have one last question for you. And then Curtis and Tom Quaadman, I'm going to come back to you to give you each one chance to just say one more thing is that you want our audience to take away today. So Tom Sullivan, I have a question about CDFIs, which is Community Development Funding. You can tell us what it is. And they're a source of funding for small businesses. We talked about small business loans and maybe a credit crunch. But this person is asking, do you think this could impact funding for and from CDFIs for small businesses?
Well, thank you, Jeanette. CDFIs, Community Development Financial Institutions, are set up to reach communities of small businesses that many times are impoverished areas of the country. I had talked about the importance of banking relationships. And unfortunately, there are parts of the small business ecosystem that don't have any relationships with bankers. And many times those small businesses are in impoverished areas of the country. CDFIs and other what are called mission-based lenders are intended to reach those underbanked or non-banked small business owners in order to provide credit. So when there is a downturn, when there is a credit crunch, unfortunately, that part of the small business community gets actually hurt worse. And so the importance of CDFIs actually rises in the general scheme of lending and finance for small business. So anytime there is a downturn, the value of CDFIs and mission-based lenders goes up. So the simple answer to the question is the tougher things get, the more valuable CDFIs become, especially for small business owners in impoverished areas of the country.
Thank you, Tom Sullivan, and thank you for joining me today. Curtis, I'm coming to you for any final takeaways you'd like to share with our audience.
I'll wrap up as we started just by pointing out this again. This is not 2008. It's a much different set of circumstances. The spillover to the real economy should be a heck of a lot less. So we're not running a repeat of the last time we went through something similar.
Thanks, Curtis, and thank you for being here today. Tom Quaadman, you get the last word. What do you want the audience to remember?
I double down on what Curtis just said. We are still monitoring things very closely. As I said, we advocated for our business members, but I just want to leave people with one last thought. And history comes into play here a little bit too. Many of us would say that 1980s were one of the most successful economic decades ever. We actually had a very similar issue with the savings and loans industry at the time too. So this is something that was worked through at that time. We had a very successful economy at that time. So I really don't think that this is a point where people need to start sending off alarm bells. This is something, again, that's localized, and we'll be happy to come back and talk further if things develop.
Thank you so much, Tom. It was a really good discussion, and I think our audience appreciates all of your time and expertise, so thank you. To our audience, thank you so much. We really appreciate you joining us today. And of course, I want to thank our sponsors once again, Dell, FedEx, Oracle NetSuite, and Iron Mountain. We always are appreciative of your partnership in this series and all of our co-events. To the audience, you will be receiving an email later today with a recording of this event, so you will be able to watch it again or share it, and we hope that you do. And I hope that you come to CO, which is the publication I am the editor of at the U.S. Chamber, where we are creating content for small businesses all the time to help you run your businesses. You will also be receiving an invitation to my next event at CO, which will be March 30th. And coincidentally, actually, it's about managing your cash flow, which we had planned a long time ago. So it couldn't be more relevant. So thank you to my guests. Thank you to the audience, and everybody take care.